Ever wonder how the mega, super, ultra rich invest? Well, our next guest has some key insights on how the ultra high net worth individuals allocate their portfolios and lessons you might be able to take from them. To discuss, we've got Anushka Gupta, who is the Goldman Sachs Apex Americas head. Great to have you here in studio with us.
It's great to be here. Thanks for having me.
Absolutely. So let's dive into this. What is the number one trick that you see a lot of ultra high net worth individuals deploying to make sure that they're not just achieving millionaire status, but maintaining it over time?
Yeah, thanks for the question. You know, in our work with very large family offices, we find that two key themes sort of emerge in their approach to investing. One is their ability to take risk, and the other is their ability to bear illiquidity and be patient from a very long-term perspective. We find the investors we work with maintain a large allocation to alternatives. We recently did a survey of 170 global family offices that reflected that the average allocation to alternatives is 44%. You know, as our investment strategy group recommends broadly to our ultra high net worth clients, that recommendation for alternatives is closer to 25%. But many of these families have a multi-generational investment lens. They have other sources of liquidity in their portfolio, and that tends to drive these biases.
Okay, so say I'm not an ultra high net worth individual. I'm just a net worth individual, and I'm trying to invest or at least position like a ultra high net worth individual. What is perhaps the proportional mindset that I should have in order to perhaps bring this into a more kind of bite-sized element for my own investing strategy?
Absolutely. I think the overarching principle is having a plan and an asset allocation framework. The second is diversification, because ultimately, if anyone takes concentrated bets in a certain position or a certain asset class, it can be not the right approach long term. And then I think the main thing is being invested over a long period of time versus trying to stock pick, because ultimately, one, you have to pick the right time to enter. If you sell, then you have to pick the right time to re-enter, and you pay taxes along the way. And so our recommendation to investors is to be diversified and think through the long-term approach to investing.
What percentage of their income even do you see the ultra high net worth individuals just setting aside or just putting straight back into an investment strategy?
Yeah, I think, you know, there's a component to ensure that your lifestyle and your needs are met. But ultimately, we guide it based on what we know a diversified portfolio can yield. And ultimately, this increased rate environment that we've been in has helped to support a lot of the yield and cash flow needs for this investor community.
How is the rate environment really changing, if at all, the thought process for ultra high net worth individuals?
I think it's setting the bar higher, you know, as opposed to just investing in risk assets. There is, you know, from a risk reward perspective, really interesting opportunities in the fixed income markets as well. And so that cash flow changes how investors think about the opportunity cost when weighing one asset class versus another. And in periods where the markets have rallied quite significantly, you know, you might think that giving up a certain amount of return to focus on cash flow instead could be an interesting strategy.
And so what the ultra high net worth individuals also do really well is compound their returns. Where are the kind of early benchmarks that one could set up for themselves to make sure that they're just having a good rate of compounded return over an extended period of time?
Yeah, I think it comes back to diversification, which is the key. But as you think about long-term equity exposure as an example, the S&P 500, which is a market-weighted index, is a really good proxy for that. And so to see how the S&P performs over time with the construct of a diversified portfolio, I think makes a lot of sense.
How do I resist the urge to say, I just want to outperform the S&P 500 every single year? I want to make sure that the S&P 500 is not even in the same stratosphere of the returns that I'm getting on my investments.
Yeah, I think, you know, you have to look to money managers and professionals to do that. It's not, stock picking is not easy for the everyday investor to do. But what we think, you know, markets are pretty efficient. There's a lot of information out there today, and so finding asymmetric information in return has become harder. So we actually see that investors look to their alternatives portfolio as an opportunity and a mechanism in the portfolio to actually outperform because you have a longer time horizon. And as companies are private, you know, you may have an edge in terms of what information an investment manager can access versus what companies report in the public markets.
You mentioned alternatives. What is the hottest alternative investment that you see ultra high net worth individuals piling into right now?
Yeah, piling into, there's a lot of the family offices we work with are pretty balanced in their approach. Private equity within the alternatives ecosystem remains the largest allocation of that 44% number I mentioned. That stands at about 26%. Given the multi-generational lens, venture capital and sort of the hub for innovation is a really interesting area of the portfolio as well. And then real estate, you think about your portfolio, what's the goal? Let's beat inflation. And so real estate is an important segment of that portfolio as well.
All right, I was hoping you were going to say collectible sneakers so I could offload some of the ones that I have in cold storage right now. Anushka Gupta, who is the Goldman Sachs Apex Americas head, thanks so much for taking the time.
Of course, thanks for having me.
Certainly.